This is a second part to our series on measuring risk, statistical concepts for advanced strategy development. And just to recap, last week we focused on popular metrics for historical risk. More specifically, we focused on historical volatility, beta, and conditional value at risk, or CVaR. In the next few segments, I want to focus on forward-looking metrics. And in this segment, we are specifically going to be focusing on implied volatility and how it can be used to assess risk for both stock and options traders. Implied volatility is like, you can use it for stock trading, but it's maybe the single most important metric for options trading. And so this piece is really going to talk about what it is, what it means, kind of where it comes from, and hopefully elucidate a little bit as to what this very important metric actually is used for. Okay, so let's hop into it. So this is the kind of outline of this series that we've been talking about. We focused on the historical metrics. Now we're looking into forward-looking metrics. There's a bunch of concepts that I want to talk about when we talk about projective metrics or forward-looking metrics. But today I mostly want to focus on implied volatility because it's again very important for options traders. And I think this also has applications for stock traders. So this is kind of the one that I want to start with. We use it all the time. Now let's see sort of where it comes from. So implied volatility of an asset is the market's volatility forecast for the asset implied by the prices of its options. We're going to talk about exactly what that means in a minute, but basically implied volatility gives you the expected one standard deviation range of annualized returns. So for example, a stock that's trading at $100 with an IV of 10% has a 68% chance of ending up between $90 and $110 by the end of the year, according to the market. Where does the 68% come from? So we are looking at the expected one standard deviation range of annualized returns. A standard deviation range for the normal distribution, which comes up a lot in finance, occurs with 68% probability. So occurrences within a one standard deviation range, that's about 68% of the occurrences. So when we are looking at the expected one sigma range of annualized returns, what that basically means is that is roughly the range that the stock price is most likely to wind up between over the next year, at least according to the option prices. And I'm going to talk about how those factor in a second. But does that make sense?
Yes.
Sweet. So instead of looking at historical volatility, the historical standard deviation range, we're looking at a forward-looking standard deviation range. And when we look at the implied volatility index, such as the VIX, that's given in an annualized format. And I'll talk a little bit about how to actually change it to look at different forecast periods instead of 1 year. But when you see an implied volatility percentage on trading platforms, or when you look at the VIX, that's what that means. Okay, so let's do a quick and dirty explanation of how IV is derived. So technically speaking, and I'm going to talk about this more in a second, but technically speaking, implied volatility is the value of volatility that would make the current price of an option fair according to some pricing model like the Black-Scholes. Technically, that's what implied volatility is. And let's talk about exactly what that means, because it's actually not that tricky to understand, but that's the technical definition. So what this means is, let's start by looking at a model for a theoretical fair price of an option. So this is from Black-Scholes, right? So to calculate the fair theoretical price of an option, there's a number of parameters that we need to use. This equation is what we use when we're calculating the fair theoretical price of a call option. You don't need to understand exactly what this means, but what you need to know about how this is relevant to implied volatility is that we need to make a number of estimations in order to actually calculate what that fair theoretical price is. That table has all of those different parameters that we use to calculate that fair theoretical price. And we need to estimate certain variables such as risk-free rate, which is R, and the volatility of the underlying. We need some estimate for volatility in order to figure out what that fair theoretical call price is. And that's what that sigma is. And I included the equation so you can see kind of how it factors in. So sigma comes up in a bunch of these terms. It's really important estimation that we need to make in order to figure out what the fair price, mathematically speaking, for an option should be. So we make this estimation around volatility, that sigma term. Typically, what we would use to estimate that volatility is historical returns. So we would look at the historical annualized returns of the underlying. And another aspect of this model is that we assume that volatility is constant. So we are looking at these historical values for volatility, which we talked about last time, actually, historical volatility. We use that as an estimate in this model for the volatility of the underlying, which plays a pretty important part in how we price the actual option. The other kind of fallacy in the model is that we assume volatility is constant. We know that it is not constant. We see the VIX change all the time. But these are sort of like two limitations of the model. We have to make some kind of estimation, and this is how we're going to do it, at least within the context of Black-Scholes. So what we see in practice is that when options are actually traded on real markets, they usually differ from their theoretical estimates. And so what implied volatility really is the value of volatility that rectifies that pricing difference. So we have our theoretical price for a call option, which is going to be C. So that's in that first column on the left-hand side. And we take a number of different parameters, plug it into the Black-Scholes, and that's how we get our theoretical price for the call option C. Right? So we take S naught, we take K, we take R, we take T, we take sigma HV, right? Plug that into Black-Scholes, we get some price. And then we say, okay, so when we actually look at how this option is trading on real markets, we get a different value. Here that's represented with CVaR. So our theoretical price is C. The actual value that we measure is CVaR, right? So let's see with the bar, so that's that middle column. Now what we do is we numerically solve for volatility. The volatility that, when we take all those parameters and plug it into the Black-Scholes model, there we go, we actually get CVaR, the actual like observed value for that call option. So that's all implied volatility is. We're just playing around with a couple different volatility values until the price that we actually see matches the price that we get from the model. So that is the volatility that is implied by the prices of the option. This is the perceived risk that investors see in the market, which explains why they are willing to pay a certain amount for the option and reflected in that price. Does that make sense?
Yeah, makes sense.
Easy, right? So that's all implied volatility is. It's really that value of volatility that when we plug it into the model, we actually get the value for an option that we see in reality. And so what that basically means is that because, right, options are used by investors as sort of like a financial insurance to protect themselves against future price movements, what we can conclude is that implied volatility is a forward-looking metric. It gives you the estimate of volatility that investors are expecting or anticipating throughout the duration of the contract based on how much they're willing to pay for the option at the time, right? So the higher the premiums, the more investors are willing to pay, the higher the perceived future risk, hence why we consider it a forward-looking metric. And so when we actually use it, it can be used for a number of different purposes, right? So implied volatility, it can be used in stock trading. It is absolutely critical for options trading. And when stock traders might want to use it, it might be, for example, to look at the most likely price range that an asset might move between over the next year. All right, so we're looking at the expected price range that we can calculate from implied volatility. So that's really the market's estimate for what the market thinks is the most likely value or series of values that this stock could have, right? With that 68% likelihood level. And you can scale the implied volatility according to different timeframes using this formula. So while implied volatility as a percentage, it gives you an annual expectation, that annual expected range. You can also use the stock price times the implied volatility times the square root of the number of days divided by 365 to maybe look at the expected range over 10 days or 20 days or 30 days. You can scale the implied volatility using this equation. Comes with a number of caveats. If implied volatility is really, really, really big, then this estimate becomes much less accurate. And it also assumes symmetry. We assume that the expected move to the upside and the expected move to the downside is equally as likely. But in practice, sometimes it can be skewed. So investors might be more concerned about risk to the downside versus risk to the upside. But our expected range calculation or estimation or approximation doesn't tell us that information, doesn't tell us that subtlety. But if we're looking at an expected range, we can still use implied volatility to really estimate that. The other one is that options trading completely relies on implied volatility. It is an extremely important metric for options trading. And typically we don't use implied volatility directly. We use some kind of relative measure, because a lot of the time we want to know, is implied volatility relatively inflated or relatively deflated? So we might use a relative measure like implied volatility rank, IVR, or implied volatility percentile, IVP, to measure that relative difference in volatility. And that can tell us a bunch of things, such as opportune times to buy or sell premium, because when IV is high, their premiums are higher, they're more expensive. But there's also a higher likelihood of a volatility contraction and historically lower outlier risks. At least that's what we observe when we look at actual data. So implied volatility is very important for options trading. Maybe I'll make a whole other piece about that. But really, we use it a lot of the times. Options traders use it as an indicator to identify good times to sell premium, change your allocation, change your diversification, other aspects like that. So the pros and cons of using implied volatility. The pros are it is a forward-looking metric, which can be immensely helpful. It gives us a forecast, which can be very useful. It's easy to interpret, and it also reflects market sentiment. Remember, like when we're using implied volatility, this is based on how investors are using options to protect themselves. So it gives us an idea more of market psychology than anything else, based on what investors fear. And then one of the other pros is that it tends to significantly overstate realized volatility. So the implied risk tends to be a lot higher or larger than the actual realized risk, which is helpful for options traders, but not necessarily for stock traders. It can actually potentially be bad for stock traders. So for me, I put it in a pro and a con, depending on what type of trader you are. The cons are that it is highly sensitive to changes in market shifts, because again, it's a map of like investor psychology almost. So if investors freak out, even if the market is not moving very much, right, that can cause implied volatility to spike very significantly. So it is very sensitive. We see that with the VIX all the time. The VIX can be very volatile itself. It's also dependent on a model, right? So there are assumptions that certain models make. And so as a result of that, because implied volatility is model dependent, if there are flaws in the model, there can be flaws in the metric. So that's another one. It's not directional. It doesn't tell you which direction the risk is really in. It just gives you a range of different possible price values. And then in addition to that, it tends to significantly overstate realized volatility. So for options traders, implied volatility can be a very useful metric because it might tell you an overestimate for what the risk might be, which is important for options trading. If a stock trader is trying to use it and it overestimates the level of risk, that can introduce problems for stock traders. So it really depends on like what type of trader you are in terms of like how you would use it. But those are the pros and cons. In conclusion, implied volatility for an asset is the market's volatility forecast for that asset, implied by the prices of its options. So stock traders can use implied volatility to estimate the most likely price range for a stock, and options traders can use implied volatility to identify opportune times to buy or sell premium. I hope this showed you guys a little bit more about where volatility actually comes from, how we use it, and sort of like how it fits into this like larger series that we're trying to do about risk. This was one of those. I do also want to focus on forecasting, specifically looking at simulations and how those work, and then maybe more option-specific risk factors such as the Greeks, which like Delta has a little bit of bearing on stock trading, like can use it as a stock trader, but most of the Greeks are pretty specific to options trading. So make sense?